It's all about the money. It's all about the dum dum da da dum dum. I don't think it's funny. See us fade away. It's all about the money.
It's all about the money. Markets waiting for Donald Trump to show them the money, where it's going to come from, where it's going to go. Straight on the heels of President Trump's address to Congress, we're joined in the studio by Eric Swats, Head of Asset Management at Rasmuller. Eric, thanks so much for coming in this morning.
Good morning. Thank you. It's a pleasure to be here.
And we're looking forward to you putting the speech in context and telling us what it means for investors and for markets. But let's just kick off putting this in context. Why is the speech that we've just seen or heard so important? What's it supposed to actually do?
Well, this is a speech which is required by the president each year to come in front of this joint session of Congress and announce the State of the Union. I guess technically this is not a State of the Union address, as it's he is only taking over the position, and during the first year of his term, it does not technically count as a State of the Union address. But it brings together all of the senators, all of the congressmen, it brings together the military, it brings together the Supreme Court justices, and gives Donald Trump a platform for announcing his initiatives and the plans that he has for the economy, his legislative initiatives, and as well to, I would say, talk to his base, those investors, those voters who have shown support for his initiatives and were able to put him in office to begin with.
Okay, so let's look at what markets were hoping to hear from this speech. Markets have been a little bit cranky leading up to this speech. They've given him a very good run so far, as we actually heard during the speech itself. What was needed?
Well, I think from that perspective, many investors are looking to Donald Trump at this point in time to lay out the priorities vis-a-vis the agenda that he's outlined already. The agenda with respect to corporate tax cuts, the agenda with respect to infrastructure spending, defense spending, these items have been well telegraphed, and investors are quite aware of the intentions. What investors are looking for now at this point is the priority of these initiatives and the timing of these initiatives. There has been already a fair amount of, investors placing their money on the back of the expectations of this pro-growth set of policies. Now investors want to see when. Is it going to happen this year? Is it something for the 2018, 2019? Because the investors themselves will start to reallocate monies if they don't see the initiatives coming quite quickly.
For me, one of the most important things that he's promised to do is to cut corporate tax in the United States. It is very, very high, 35% at the federal level, up to about 40% when you put in state taxes, one of the highest in the world. And he was talking about that during his speech. Let's just remind ourselves what he had to say this morning.
Right now, American companies are taxed at one of the highest rates anywhere in the world. My economic team is developing historic tax reform that will reduce the tax rate on our companies so they can compete and thrive anywhere and with anyone. It will be a big, big cut. At the same time, we will provide massive tax relief for the middle class. We must create a level playing field for American companies, and our workers have to do it.
Big. That's as specific as he got. What are you expecting? What would you like to see, Eric?
Well, I think there are a couple of points. One is the U.S. corporate tax rate is very high. Many countries over the past several years, decade or so, have been reducing their corporate tax rate. And that has led to companies resetting their headquarters in foreign jurisdictions where the taxes are quite low, these type of inversion mergers. We'd like to see the tax rate drop towards 15%, which would make it competitive on a global basis, which would keep the companies in the U.S., encourage them to stay in the U.S. as opposed to creating a disincentive for them and encouraging them to relocate their headquarters out of seas.
President Trump's been promising a, and I quote, phenomenal tax plan, and he had sort of said that we'd get details within 2 to 3 weeks. I mean, that would be now. Those details don't seem to be there. How do you think the market's going to react to that?
Well, this is probably the most important aspect, and more recently the Trump administration has suggested that they will deal with the healthcare appeal and replace vis-a-vis Obamacare before they attack the tax plan. And if we have that type of postponement, if you will, i.e. we don't start to see the tax plan till much later in the year, it could well lead to investor disappointment in the near term.
Okay, let's actually just listen to what President Trump had to say about repealing Obamacare.
Tonight, I am also calling on this Congress to repeal and replace Obamacare with reforms that expand choice, increase access, lower costs, and at the same time provide better health care. Mandating every American to buy government-approved health insurance was never the right solution for our country. The way to make health insurance available to everyone is to lower the cost of health insurance, and that is what we are going to do.
Well, of course, it's about the spending, isn't it? It's about the give and take, both sides of the balance sheet, where you're going to put it and where you're going to take it from. He's asked Congress to approve about $1 trillion in spending, Eric, but again, not a lot of flesh on those bones.
That's correct. And market participants remain watchful and mindful. Where is that money going to come from? What are the implications of the reprioritizing of the spending in the U.S.?
And if we look at healthcare in particular, I mean, this is a Gordian knot, isn't it, Eric? I mean, it reminds me of the Hillary Clinton trying to impose healthcare reform back in the early 90s when her husband Bill was president, and that didn't really come to anything. And Obama got Obamacare through. I mean, we're not here to discuss the kind of the ins and outs of the American healthcare system, but generally speaking, it seems to be almost a kind of a problem without a solution. Is it just something that America's going to have to muddle along with, or is there some kind of final solution for this?
Well, America has a healthcare system. It tends to be very expensive. There is a government-sponsored healthcare system in place for elderly and very poor. What they've tried to do more recently, particularly with Obamacare, is to get everyone to sign up for insurance by mandating everyone's obligation to buy insurance. As a result of that, hopefully lowering the cost of insurance. What we've seen in practice is actually the cost has gone up. So from that perspective, it still remains a Gordian knot, as you mentioned, a very difficult item to tackle.
It's very easy to criticize other people's healthcare plans, but I suspect it's somewhat harder to impose one that actually works and delivers affordable care in practice. But of course, these things do cost money, and defense spending will cost money. A couple of days ago we heard, didn't we, his plans to ask Congress for a 10% increase in military spending, an extra $54 billion. He's been talking about that again.
And calls for one of the largest increases in national defense spending in American history. My budget will also increase funding for our veterans. Our veterans have delivered for this nation, and now we must deliver for them. The challenges we face as a nation are great, but our people are even greater, and none are greater or braver than those who fight for America in uniform.
So you're a head of asset management, Eric, so you look at this, as a lot of people do, as an investor and thinking, well, where should we put our money, where should we put our clients' money? We'll talk about this in a bit more detail when we come back, your investment theses at the moment. But generally speaking, if you look at a policy statement like this, can you just go out and go, okay, Trump wants to increase military spending by 10%, go out and buy shares of Lockheed Martin? Is it as simple as that?
I think you'll see that type of reaction in the financial markets. Also with respect to infrastructure spending, you would see steel manufacturers, material-based companies, their shares performing well in this environment.
Wall-building companies.
Cement-making companies, for example. If you're going to build a big wall, you need a lot of cement. So those companies that produce cement will be certainly targets for investor interest.
Were they really waiting for this speech, though? I mean, he did mention again, and I quote, a great, great wall, and he spoke again about those pipelines and the fact that they will be built out of American materials. But are people actually waiting for him to say it in Congress before they go and invest?
Well, President Trump has been in office now for several weeks, and depending upon how you view the activity of the first few weeks, many people characterize it as a bumpy start. There were a couple of resignations, changing tact with individual people. Now people want to see the legislative activity coming from the Trump administration. The Republicans have, control of both the Senate as well as the lower house, the House of Representatives, and it's time now for the legislative activity to take place. And really this address is kind of the kickstart of that process where we will start to see the legislative initiatives take place, as opposed to the forming of the cabinet and the appointment of other individuals who will serve the president.
We're looking at President Trump's speech to Congress. He finished about 20 minutes ago. We were looking at issues he raised, such as healthcare, such as trade, such as taxation. Now let's look at what it means for investment strategy. And was there anything that you heard that would change your investment strategy for your organization, for your clients?
There's nothing that we heard from Trump's speech which would cause us to reset or readjust our key investment strategy. I think what is important, which we haven't yet covered, is the implications for economic growth and Federal Reserve interest rate policy. We now expect the Federal Reserve to be raising interest rates on a pretty steady path out over the next period. 3 interest rate increases for 2017, quite possibly the next one coming up at the meeting in March. This will have a direct impact here in the Emirates and other dollar-linked countries and economies, as the central bank here begins to raise interest rates to maintain the dollar peg, and we start to see banks rising interest rates as well, impacting home loans, the residential real estate market, and other financing opportunities.
Typically, we would think of an interest rate hike as acting as a drag on the economy. It makes borrowing more expensive. Households have less spare money if they're paying higher mortgage or car loan repayments. Businesses are less likely to take out a loan to build a new factory. That's kind of economics 101. In practice, and you've been here a long time now, Eric, what do you think will happen as we transition to a more normal interest rate environment here in the UAE?
Well, the challenge, of course, for the UAE is that higher interest rates might not be the right economic policy for the economic situation at this time, given the decline in oil prices, which we've seen, and the consequential impact on economic growth for the Emirates. So the conundrum at this point in time is, how does the economy weather the rising cost of funds at a time when the economy itself is still dealing with the consequential impact of lower oil prices.
And of course, the corollary of higher interest rates in US dollar terms may well be a stronger US dollar. And that's also a headwind for some industries here in the UAE. The hotel industry becomes less competitive. The retail industry also faces challenges. So what's your thesis on the US dollar going forward?
Well, we saw the US dollar move up quite sharply post the election results. We've seen it soften a little bit since then. And we would expect the U.S. dollar to remain well bid to strengthen further against the major trading currencies, against the British pound, against the euro, against the yen. And as a result of that, we will see further pressures from a rising dirham against the other major trading currencies, causing headwinds, if you will, against these type of aspects for money flowing into the country.
Talk to me about making investment decisions in a time of such, I don't know if uncertainty is the right word, certainly unprecedented is a good one. I mean, not just with what we're seeing in the US, but also with Brexit, also what people are watching for in a number of European elections. How do you steer that ship, Eric?
What we've seen from our investors and what we've been advising investors on for the past 3 years really is to focus on absolute return investments that are uncorrelated to the direct movements of equity and bond markets. We've been helping investors access private market lending opportunities through our trade finance fund, as well as equipment leasing strategies and real estate. So we see a lot of investor interest in these strategies, which will perform in an uncorrelated manner to what we see in the broad equity and bond markets.
Such as
trade finance, such as equipment leasing, as well as real estate.
Okay. What are the big themes that you are chasing at the moment outside of that?
Well, these are the big themes that we're chasing. The other is to work on. I mean, there are opportunities in the equity markets here in the region. We have had this, how should I say, readjustment phase take place over the past 18 to 24 months as oil prices come down and expectations themselves have changed. These are expectations with respect to growth in the economy and expectations with respect to the performance of the corporates that are operating in this economy. Our sense is that this adjustment phase is well underway and that the equity markets will begin to anticipate the bearing of the fruits phase, which will be coming up. So we ourselves are also quite bullish on the equity markets of this region. However, many people still have the memories of higher prices in the past and that the equity markets themselves are underperforming. But if you take a forward-looking approach and you believe this thesis that the readjustment phase is well underway and that the bearing the fruits phase is in front of us, then you'd want to be establishing your positions now at this point in time.
So finally, pulling all this together, given that we have a Trump administration in the White House, given the economics of this region, if I'm going to give you $1 million to invest for me when you walk out the door today and you're going to take it back to Ras Mallah headquarters in DIFC, where would you put that $1 million? What could you do for me?
Well, when we talk to large institutional investors, whom we principally serve as investment managers, we have very well diversified portfolios. So if we're looking at that quantum of money, we've got a diversified allocation, some into fixed income investing, some into local equities.
And what kind of yield would you get me on that?
They're fixed income portfolios of regionally domiciled issuers, anywhere between 4 to 5% yields, right? Higher than bank deposits are what are paying, but nothing that is going to be of super high returns. In the equity markets of this region, we're looking for returns that are going to be in the 12 to 15% range for the course of the year. And then we would add around this core approach alternative investment strategies. This is very much focused on real estate and private market lending strategies, which will perform well irrespective of the broad movements in the equity and bond markets.
And what kind of yield would you get me on those?
Well, in the trade finance, we're getting yields that are around 5-6%, equipment leasing 7 to 8%, and real estate, depending upon the individual property, anywhere from 10 to 12% in the local markets down to 6-7% in, let's say, the UK or Germany.
Sounds good. Checks in the post. Eric, it's really nice talking to you. You've been coming into the Business Breakfast studio for 12 years now, and we always appreciate your insights. Eric Swats is the head of asset management at